You think you're buying gold. Think again. You're buying into the most authentic, tangible anxiety of our time. This isn't just another investment craze. This is a global psychological chess match played with pawns of trust, fear, and the raw instinct for survival. And if you stick with me to the end, you'll understand who's really winning and who's about to lose their shirt. Let's talk about something shiny: gold. Recently, its price has shot up faster than a firework on the 4th of July. The news is a broken record. International gold prices have hit another all-time high. We've seen it blast past $3,800 an ounce, with the year-to-date gain rocketing towards 45%. And the domestic brand-name jewelers? They're on another planet. The price for gold jewelry has soared to 1,120 yuan per gram. You heard me right. We used to buy jewelry by the piece. Now you have to calculate it by the gram, like you're handling saffron. Buying a decent-sized bracelet feels like putting a down payment on a house. But that's not the most interesting part of this story. The truly bizarre, almost magical twist is this. While gold prices are going through the roof, many of the famous old-school gold stores we all know are shutting their doors in despair. Last year, Chow Tai Fook closed 397 locations. Lao Fangshang shuttered 297. It's like watching a mass retail exodus. Now, this makes no sense, right? Logically, when the price of your product skyrockets, you should be swimming in profits, counting cash until your fingers cramp. So why does it look like they're going out of business? Today, we're going to dig deep and get to the bottom of this. We'll find out who's really feasting in this golden banquet and who, as Warren Buffett would say, has been caught swimming naked when the tide went out. To understand this madness, you can't just skim the surface. You have to dig into the foundations. Many will tell you, oh, it's because the Fed is about to cut interest rates, or there's a war somewhere. And they're not wrong, but those are just the sparks. The real powder keg is a growing global crisis of confidence in the former king of currencies, the US dollar. For decades, the dollar was the world's bedrock, but now the guy running the printing press is drowning in his own debt. The US national debt has surpassed $37 trillion. That's over $100,000 of debt for every single citizen. And to make matters worse, America has developed a nasty habit of weaponizing its currency. Freeze this country's assets, sanction that one. This has central bankers all over the world clutching their massive dollar reserves, starting to sweat. Imagine you've stored all your life savings at your neighbor Bob's house, but then you notice Bob is getting into fights every day and is up to his eyeballs in debt. Wouldn't you be a little nervous? You'd be sprinting over there to pull your money out and trade it for something solid, something no one can take away. And what is that solid thing? Gold. For thousands of years, it has been the ultimate form of payment backed by nothing but its own scarcity in history. So now you're witnessing a strange spectacle. The world's central banks have been on a historic buying spree, snapping up over 1,000 tons of gold annually for several years straight. China's central bank has been increasing its gold holdings for months on end. Even European countries like Germany and Italy are busy flying their gold reserves home from vaults in the US. The symbolism of that move is far more potent than the logistics. It's a global announcement that says, we're looking for an exit strategy. When the national teams are hoarding gold with the frenzy of shoppers on Black Friday, what do you think happens to the price? This is no longer just investing. This is the global de-dollarization escape plan. And gold is Noah's Ark. Transitioning smoothly. Of course, the expectation of Fed rate cuts has certainly added fuel to the fire. The logic is simple. Gold is a chicken that doesn't lay eggs. It pays no interest. When the Fed raises rates and you can get a handsome return just by saving dollars, the opportunity cost of holding gold is too high. But the moment the market expects the Fed to start cutting rates to save the economy, the tables turn. The appeal of the dollar fades, and suddenly its eternal rival, gold, starts looking mighty attractive. The market always plays on expectations. The smart money smells the change in the wind long before the storm arrives, pushing the price up in advance. And let's be honest, the world is a messy place right now. Geopolitical conflicts are simmering everywhere. When people get nervous, their primal instinct is to seek shelter in the safest asset they know. Gold is the oldest, most reliable insurance policy in a world that feels increasingly unstable. Just look at the holdings of global gold ETFs. Hundreds of tons have flowed in this year alone. It's not just central banks. Ordinary investors are casting their votes with real money, a vote of no confidence in the system. Okay, so now we understand the deep currents pushing gold's price into the stratosphere. But this brings us back to our paradox. Why are the jewelry stores dying? The secret here is more complex than the engravings on a golden bracelet. The key is to distinguish between two completely different things. Investment gold, the bars, the coins, the ETFs that people are scrambling to buy, and decorative gold, the consumer goods that jewelry stores primarily sell. Yes, they're both made of gold, but they're not the same game. For a consumer, the price of a piece of jewelry is incredibly inflated. Let's do the math. The international spot price might be, say, 800 yuan per gram. But in the store, that same gram costs you 1,050, maybe even 1,120 yuan. What's in that extra few $100s? A massive brand premium, a hefty design fee, complicated craftsmanship costs, plus the store's rent and the salesperson's commission. Explaining the psychology, when gold prices were stable, people accepted this. You bought jewelry to wear for its beauty, for the ritual of a wedding. But when the price spikes to heart-stopping levels, the consumer's mindset shifts. The person buying jewelry thinks, this is ridiculously expensive for something I just wear, and it has zero value as an investment. They know that when you try to sell it back, all those markups, the brand, the design, vanish into thin air. You lose over 400 yuan per gram, a sting more painful than selling your stocks at a massive loss. Meanwhile, the true investor thinks, why on earth would I pay for all that fluff? They can just go to a bank and buy a pure gold bar with a tiny premium. It's a pure play on the asset. And today's younger generation is savvier than ever. They've realized that the gold beans they painstakingly saved up for might even sell at a loss to a jewelry store. So they're bypassing retail and going straight for pure investment. Moreover, consumer trends have changed. The biggest driver for gold jewelry used to be weddings, a non-negotiable expense. But the younger generation's enthusiasm for marriage is, well, even when they do buy, they're more rational. A 30-gram bracelet is out, but a 5-gram gold bean is a bestseller. The motto has become, it's the thought that counts. Introducing the disruptor. The mortal blow, however, comes from disruptors like the Shenzhen Shuibai market. Think of Shuibai as the wholesale warehouse of the gold world, or maybe the Amazon of gold. They sell directly to consumers at the international spot price, plus a tiny fee for labor. No middlemen, no ridiculous markups. It's like this. You're used to buying a can of Coke for $1 at the corner store, but suddenly, an app appears that delivers the exact same Coke from the warehouse for 50 cents. Would you ever go back to the corner store? The traditional jewelry chains are facing that exact kind of dimensional reduction strike. They're stuck with high overhead and an outdated model, and they're being completely blindsided. So, the jewelry stores are trapped. Their cost of raw materials is soaring with the international price, but demand for their finished product is plummeting because of the high prices, shifting consumer habits, and new disruptive channels. It's like being a baker whose flour price hits a new record every day, but no one will buy your bread if you raise the price. You're simply squeezed to death. Some stores, in their desperation, have even started illegal gold hosting schemes promising high returns. In reality, it's just a Ponzi scheme. The cash flow breaks, the boss vanishes, and investors are left with nothing. That's not business, that's playing with fire, and they're burning themselves and their customers. So if not jewelry, where is the smart money going? This brings us to a brilliant financial tool, the gold ETF. For the average person, buying physical gold is a headache. You worry about it being stolen from your home, renting a safe deposit box is costly and inconvenient, and selling it can be a hassle. The gold ETF solves all of this. Think of it as a digital claim check for gold. You don't hold the physical metal, but the value of your shares tracks the international gold price perfectly. You can buy and sell it instantly in your regular stock account, just like any other stock. The barrier to entry is low and the liquidity is high. This is a game changer because it gives you direct access to gold's financial properties, allowing you to completely bypass the consumer traps of the jewelry store. You're buying a piece of a globally traded asset that moves with the winds of world events, not an overpriced commodity wrapped in layers of marketing. The data speaks for itself. The number of new gold ETF accounts opened in 2025 surged by 400% year over year, with millennials and Gen Z making up over 60% of the new investors. There's a joke online now. In the old days, a wedding required 3 pieces of gold. Today, a portfolio requires 3 kinds of gold: gold ETFs, gold mining stocks, and gold futures. So, you must be asking, is it too late? Is this a bubble? Has the ship already sailed? That has become the soul-searching question. From a long-term perspective, the fundamental drivers, de-dollarization, global uncertainty, central bank buying, show no signs of reversing. Some analysts are calling for prices of 4,000, 4,500, or even higher. But in the short term, after such a massive run-up, the market is packed with profit takers. If the Fed's rate cuts are slower or smaller than expected, or if a geopolitical hotspot suddenly cools down, a sharp correction wouldn't be surprising at all. There's an old saying in finance: bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Right now, the sentiment around gold is at the very least optimistic, with a dangerous hint of euphoria. So if you're thinking of going all in right now, you'd better buckle up for a roller coaster. As a component of a diversified portfolio, gold is essential. It often moves inversely to stocks and bonds, acting as a powerful hedge. Keeping 5 to 10% of your assets in gold is like having a world-class defender on your team. He might not score the winning goal, but he'll make sure you don't lose the game badly. However, if you're coming in with a go for broke, turn a bicycle into a Bentley mindset, hoping to get rich quick, I urge you to calm down. The price of gold is a battlefield where the sharpest minds in the world are at war. You, as an individual with limited information, are walking into the crossfire. Chasing the price at its peak and getting trapped is a miserable experience, perhaps even worse than in the stock market. Because gold pays no dividends. Your only hope is that the price goes up. How many people remember the peak in 2011, followed by years of a brutal bear market that trapped an entire generation of believers at the top? Gold prices are soaring while gold stores are failing. This contradiction reveals the dual identity of gold in our modern economy. On one hand, it is the ancient financial ballast, carrying thousands of years of trust, the final fortress for nations and individuals against uncertainty. On the other hand, it is a common commodity held hostage by consumerism, brand markups, and bloated cost structures. When the storm hits, people will cling desperately to the ballast that can save their lives. They will, without a moment's hesitation, cast aside the beautiful, overpriced, and ultimately useless packaging. This great drama of conflicting aesthetics is in the end the triumph of rationality in an age of fear. For us, the ordinary people, understanding this drama can give us a measure of clarity in a world flashing with gold. Riley, after all, in the game of wealth, surviving is always more important than winning fast. The price of gold now scrapes the sky as anxious nations start to buy. The dollar's throne begins to sway, while central banks all hide away their gold for a rainy day. The retail price can make you weep, while jewelry stores lie dead and deep. The ETFs are where the traders swarm, a desperate shelter from the storm. But chasing peaks is a fool's embrace, for bubbles burst and leave no trace. That's all for this episode. Thank you for watching. We'll see you next time.